3 awful myths about indexed universal life insurance that just aren't true. Welcome, my name is McCluskey. I'm a financial strategist. This year we've done just over 1.3 million in premiums or funding. Let's get into it. Number 1, IUL has hidden fees or costs that you cannot see. This might be true for whole life. This is not true for indexed universal life. When someone is running an illustration for you, all the agent needs to do is tick a little box that says annual cost summary and internal rate of return report. These will produce 2 summaries. I'll pop up the annual cost summary right now. It shows you they are 100% transparent. It shows you where and when every single fee is coming from. You can also run, with some companies, a monthly cost summary report, and it will show you every single month where those fees and costs are coming from. This is just a flat out lie. Second, for the cost of insurance, since IUL uses an annual renewable term feature, the cost of insurance will continue to rise. Therefore, eventually my premiums won't even cover the cost of insurance and it will have to eat back into my policy. Now I will say this can happen, but it never will happen if the policy is fully funded, was structured properly from the very beginning. The death benefit is reduced when it needs to be in the policy. If it started as an increasing death benefit, switch to a level at some point. All of these things should be shown to you and described when you are looking at getting a policy. The reason also that even though the cost of insurance per 1,000 is rising every year, but your cost of insurance as a percentage of your cash value and how much you're putting in isn't actually increasing, but is going down, is because even though, like I said, that cost of 1,000 goes up, you are actually paying for less insurance. So if you had a $500,000 death benefit and you had no money in the policy, on day 1, you're paying for $500,000 worth of insurance. As you get older, the cost of insurance, of course, is going to go up. If you were funding that policy with $100,000 a year for 5 years, let's say, after year 1, when you've put in $100,000, you're now only paying for $400,000 worth of insurance because $100,000 of it is cash value. The next year, when you put in another $100,000, now you only have $300,000 worth of insurance. So did your cost per 1,000 go up? Of course it did. But the amount of insurance that you are paying for actually decreases. This is why, again, and you can look at this in an annual cost summary or an internal rate of return report, why as you get later into the policy, your internal rate of return actually increases because as a percentage, your cost of insurance is decreasing. And with some companies actually, after age 95, that cost of insurance goes to 0 if you had fully funded it. Why? That's because they don't even require you to have any insurance. It can all be cash value and have all of that be considered the insurance to still be considered life insurance, and you still get the tax-free treatment. Number 3, when you die, they only pay the face value of the insurance. They don't even pay you any of the money that was building up in the cash value. It can seem like this, but this actually isn't true. If you had a death benefit, going keeping with the same example there of $500,000, and 3 years in you passed away and you had put in $150,000, you are still only going to get the $500,000. But does that mean they only paid the face value? If you think back to the example I just gave for number 2, no, it doesn't. The new face value at that time is only $350,000 because you're only paying for $350,000 worth of insurance and $150,000 is your cash value. So if you died right away on day 1, you had $0 in cash value, your face value is $500,000. If you were 3 years in, you now have $150,000 in cash value and somehow your policy did not grow at all, now you have a death benefit of $350,000. So when you pass away, you actually are going to get both of these that equal $500,000. It just doesn't look like that because now you're paying for less insurance. And you want to be paying for less insurance. If you would like to keep an additional $500,000 of death benefit every year, you actually can do that to where it pays that initial face value plus the cash value, but then you're going to be paying for much more cost of insurance, and you're not really doing IUL for the right reason. If you're trying to mix insurance and the cash growth, it's probably not the best option. You really should be looking at this as the insurance is coming along for the ride. It's a little added benefit there, but really what you're doing this is you're overfunding, you're doing it for the cash value, you're letting it grow, and you want the least amount of insurance the IRS will allow you to have for it to still be considered life insurance so you can get the tax-free benefits. I will warn, as I always do, if the policy is not structured properly and funded properly from the very beginning, which most are not, it's going to start looking like the junk that a lot of critics say that it is. On the other hand, however, if structured properly and treated with care the whole time, That's where you're going to be able to unlock the tax-free growth, access, and transfer, eliminating all risk of loss due to market downturns, and you're still going to be able to get those competitive market-like returns. This can bring a lot of peace to someone's financial situation, especially if they don't want to deal with the ups and downs of the markets. If you'd like to see what a plan would look like for yourself, book a 20 minutes quick consult with me down below. I'd be more than happy to help out.